Hey everyone, welcome back to the channel. Today I want to talk about the 5 things not to do to improve your finances. So if you're new here, so am I. I'm a super new channel and I tend to talk about personal finance bits and bobs. I've worked in finance for the last 10 years in London. I'm obviously Irish, that's what this accent is. And I just wanted to share kind of tips to help improve your personal finance, basically. Just a note, I'm not a financial advisor. I worked in commercial finance mainly. So if you've any questions about, investing or anything like that, just to seek out a financial advisor. So the first thing not to do to improve your finances is not to bite off more than you can chew. And what do I mean by this? I mean, don't buy or rent a bigger property than you can actually afford. I talk about this in a previous video where a rough guide is 50% of your monthly income should be going towards your living expenses, which includes your rent, your food, all the things to kind of keep you alive, basically. So if you're spending more than that, or maybe you're buying quite a big house and down the line the interest rates go up, can you really afford it? I've seen so many people who this happened to, where they buy a big property or they rent a big place, and then honestly, they have to get a lodger in to help pay for the mortgage or to help pay for the rent, which is absolutely bonkers. And a lot of the times they tend to hate that there's someone else in their space because it wasn't their choice initially. Another example of this is buying, a big car and having a big car payment and not actually being able to afford it in the scheme of things, because maybe you don't have an emergency pot of money, maybe sadly you're let go from your job, but you still are tied to this really big debt. Unfortunately, I've seen people who have a Range Rover and they've had to do Uber driving to pay for the big Range Rover car payment, which is absolutely insane. She had a beautiful white Range Rover and then she was just being an Uber after work to help pay for that payment. So just really silly when you think about it. So try not to bite off more than you can chew. The second thing is payday loans, or any kind of big loans with a double-digit interest rate. Payday loans are extremely dodgy and I would just honestly steer clear from them altogether. If you're in a really tough spot financially with money, payday loans I just don't think are the right scenario. So really be careful of what you're signing up to and really understand, if you're getting a loan, what's the interest rate that you'd have to pay back, because you're just going to dig yourself deeper and deeper into a hole. So the next one then, number 3, is to do with credit cards. So my point here is not to spend too much on credit cards that you can't afford, okay? And what I mean by this is don't be spending willingly on credit cards because you're thinking, oh, it's free money, I can just tap here, I can tap there, I can go on a vacation, I can buy this lovely handbag for $2,000. Credit cards are not free money, okay? You have to pay them back. I heard someone say a while ago, I think it was Jay-Z, which is really random, and he said, if you can't afford to buy something twice, you shouldn't buy it at all. So that goes for clothes, that goes for holidays. If you feel like you can't pay off a £500 credit card because you want to go on holiday for the weekend and you think, oh, that's going to be kind of sitting on me for a while and it's going to start to build up with other debt that I have, then you shouldn't do it. No way, Jose, okay? Only pay for things that you know that you can pay back in the short term. And I think that example of only buy something if you can afford to buy it twice really makes you stop and think, okay, hang on, do I need to do this thing? So the fourth thing then is going back to cars. So I think not to buy a new car outright. I've heard, again, so many people who've fallen into this trap. Thankfully, I've never have done, and because I live in London, I don't need a car, so that's perfect. But when you buy a car brand new, a lot of the time when you drive out of the car lot, it immediately goes down in value, okay? And if you're trying to sell off that car secondhand, you will have lost a big chunk of money there. So let's say, for example, you buy a brand new 2024 Mercedes and you spend, I don't know how much Mercedes is, like 40 grand on that. As soon as you drive it out of the lot, you will have most likely knocked off 5 grand, 10 grand, 15 grand, 20 grand, really high figures sometimes depending on the type of car and the model and everything else. So if you need a car, the best thing to do is to actually buy one secondhand that's in really good condition. So good condition would be really low mileage. Also the age of a car as well, Of course you might want a new car because you think, okay, it'll be most reliable or whatever. But oftentimes when you buy secondhand cars, and they're low mileage, you know, way less than, let's say, 50,000 miles, for example. It's maybe 3 years old, and maybe you can get half the price on this type of car than you would have if you bought it brand new, for example. So a lot of people can be a little bit like snobby about new cars, old cars, but like at the end of the day, if someone has really looked after their car and it's low mileage and it's a good brand like Toyota, for example, they tend to last for years, and you know, they tend to be really good quality cars as well. So have a bit of a think about this, because a lot of the time when you buy a car new, you're instantly throwing money down the drain. And the last thing of not to do to be better with your finances is, if you're investing, which I hope you are, is not to check your investments constantly. Okay, I remember watching a video with John Bogle, who of course was the founder of Vanguard, and he said that he would just set up a automatic payment every month into his investments. He was talking about S&P 500, which is an index fund, if you're not familiar with this. But essentially, he set up automatic payments. So let's say, for example, you set up £200 every month to automatically go from your current account into your investment ISA in the UK here. And the thing is, if you're constantly checking your investments every week or even every month, of course you're going to see dips and you're going to see minus percentages, and you're going to start to freak out to be like, oh my God, my money's going down the drain. You know, how should I sell them now and get my money out? You start to panic, and you start to, of course, your human emotion takes over. But what John Bogle was saying is, if you just set up automatic payments and let it run for years and years and years. Now, he was saying, set it up now and don't look at it until you want to retire or until you want to access that pod. And of course, you'll get like a big shock of, oh my God, there's been so much compound interest grown, which would be amazing. I tend to look at my investments. I try to do it only once a year. And any more than that, you can get totally wrapped up into dips that have happened. Of course, there'll be peaks that will happen, but that will naturally happen over time in any investment that you do. So that would be my tip for that. Obviously, if you haven't gone into investing, I would really recommend it. Of course, do your own research. It's your money, and it's important to understand that the money that you put into investments doesn't replicate what's happened in the past. And I really think that investments that can compound over time is a much better way to grow your wealth rather than just saving. I think investments are a really good way to grow your wealth over time, because you've got compound interest and you're getting interest on top of interest over the years that you're doing it. And if you have an automatic payment every month, you're not even thinking about it. It's just automatically going out. You don't have to look at the investment account or anything like that. It'll just grow in the background and you don't have to worry about it, depending on the economy of the investments. But it can often be a better way to grow your wealth rather than just saving in a bank account that has like a 2% interest rate. So that's it, guys. That's for me. Hopefully that was helpful. If you have any questions on any of that, I'd be happy to answer them below. As I said, I'm a super new channel here. I tend to talk about personal finance. So if that's the kind of thing you're trying to improve in your life and you're trying to scale up, then it'd be great if you could subscribe. Cool. And I'll talk to you soon. Thanks, guys. Bye.